Good afternoon, everyone. It is now 2:01. I do see individuals are logged on. We might have some additional individuals jump on here, but for the sake of time and getting through everything, just want to get the ball rolling. So, of course, welcome to today's webinar, Enrollment and Financial Aid Modeling Strategies for Higher Education. I am Mike Mooney, and of course, we'd like to thank everyone for joining us today. It's greatly appreciated, and we are glad you're here. Today, our focus will be on how colleges can model enrollment in financial aid to ensure sound financial management and planning. But before we do get things started, I would like to let everyone know that we will have a question and answer session at the end of the webinar. If you do have questions during the presentation, please note the Q&A section at the bottom of your Zoom meeting screen. Feel free to enter any and all questions there during the presentation, and both myself and John will be certain that they are covered during the Q&A session. I will also note that today's webinar is being recorded and will be sent to all attendees. I would also encourage you to share with any and all of your colleagues or associates who you think would benefit from the session. So feel free to forward the webinar at your leisure. My contact information will be available at the end of the webinar. If you have any follow-up questions or would like a personalized demonstration, please be certain to reach out anytime. For today's agenda, we will cover the following: introductions, company overview, enrollment modeling, financial aid modeling, reporting and dashboards, integrations, and to wrap everything up, as I mentioned, we will cap off the webinar with a Q&A session. In the instance we don't get to your question during that time that we have here today, I will follow up with you directly with an answer. And for today's webinar, we are joined by our Senior Associate and Higher Education Specialist, John McGrath, who will be leading the discussion. John, I'll let you make an introduction.
How's everyone doing? My name is John McGrath. As Mike said, I'm a Senior Associate at Carlson Management Consulting. I have about 7 years in financial management within higher education, both in the for-profit industry and non-for-profit industry. I was the budget director at TCI College in New York City, as well as the budget manager at Babson College in Wellesley, Massachusetts for 5 years, and have now been primarily building long-range financial planning and budget software with an adaptive for primarily our higher education clients. So I've an extreme amount of experience in this area, inclusive of some clients, or current clients actually on the call today. So I look forward to discussing enrollment and financial aid planning with you today.
Excellent. Thanks, John. And as I mentioned, my name is Mike Mooney. I oversee business development at Carlson Management Consulting. My entire professional career, spanning over about the last 15 years, has been dedicated to business development, and I've now been with Carlson for 3 years. Ultimately, my goal when working with finance teams is to provide clearly communicated, cost-effective solutions that empower organizations to gain deeper insights, greater efficiencies from your current process. And as our mission as an organization is customer-centric, our focus is to ensure your success. And for a little introduction on Carlson Management Consulting, we were initially founded in 2010. Carlson's foundation lies in our adaptive insights practice, but has since expanded our offerings across a multitude of best-in-class cloud solutions, including Sage Intacct for enterprise resource planning, DataBlend, which is our integration platform as a service, as well as Nexonia for timesheet and expense reporting, Avalara, which provides tax automation, as well as our outsourced services to organizations of all sizes and industries. I will note Carlson is a 6-time partner, Adaptive Insights, most recently earning recognition of Partner of the Region for the Americas. We've also been ranked 3 years in a row on the Inc. 5000 list of fastest growing privately held companies, as well as 4 years in a row on the Boston Business Journal Fast 50. I only mention these recognitions as they are truly an indication of our customer success, as our reputation is truly determined by each successful implementation. We have 4 offices located in Vermont, Massachusetts, Maine, and Ohio, and with a team of consultants nationwide. And what separates Carlson from the crowd is that each consultant, much like John, who you just heard an introduction of, comes to our organization with a finance background, as well as a deep technological expertise, making Carlson the cloud financial expert. And lastly, prior to handing it off to John, I always like to provide examples of recent customers. And as you can see here, we work with a variety of colleges and universities of varying sizes and structure. My hope is that this provides you a sense for our commitment to working with colleges and universities, and that we have a proven track record. And when working with Carlson and John, you can be certain that you will be in good hands. With that being said, at this point, I'd like to hand it over to John for the presentation.
Yep. And actually, what I'm going to be reviewing today is enrollment modeling, primarily, how we can forecast cohorts through your enrollment model, how we can predict retention rates by looking at historical cohorts transitioning from their freshman year to their sophomore year, as well as how to handle transfers, because transfer students tend to act differently than your normal traditional student coming in their freshman year and staying through senior year, as well as graduate and graduating students. Next, we'll get into financial aid modeling. Financial aid modeling has, for forecasting purposes, can be quite simple or can be rather complex in terms of, how are you, managing your scholarships as well as your need-based aid, pools with, certain limits, as well as, just a lot of schools need to manage to a total discount rate. So we can go over that as well. And finally, how are you going to report on this information, such as undergraduate versus graduate enrollment? Do you want to be having dashboards that show, growth rates by either enrollment or discount rates, and much more? So let's actually take a dive into adaptive. So what I'm showing here on my screen is my enrollment model, and I'll actually show a much more simple view of it to start with my undergraduate enrollment model, where where we're planning by our 4 cohorts, your freshman, sophomore, junior, and senior classes, and we also plan by semester. So in this particular example, I'm going to be showing your fall and spring semesters. Typically at your traditional 4-year college, you tend to see the summer act a little bit more differently, where you're just projecting students multiplied by an average of total credits to get your tuition revenue, versus your fall and spring modeling. We'll want to actually track how students are coming in and how they matriculate from year to year. So within this particular model, we're using a cube model, and a cube model within adaptive is primarily a way to pivot information. So we are pivoting information by your class year as well as your term, and you can view this data differently, either by focusing in on just your class and semester, or my initial view that I showed off was we're actually going to be taking a look at fall and spring, and then you can see here in summer, and then by your individual class years. So I'll, break this down piece by piece. So first and foremost, what each college needs to, kind of identify is, what is our freshman cohort going to be? How many students are we going to be bringing in? That's kind of your base point, as well as projecting how many transfers you're going to be allowing in. Now, your transfers tend to be kind of an easier metric to figure out. You normally have a list of transfers waiting to get in, and they tend to be a much their matriculation rates from application to attendance tend to be much more predictable. So that's a relatively easy number to come by. But then how do we, figure out, how these students, 727 students, how do they matriculate to their sophomore, junior, and senior year? Well, what we have done in the past is actually taken a look at retention rates. So what we're taking a look at here is your retention rates between spring and fall. And we're using history to predict how these students are going to matriculate forward. So we can see here in this continuing cohort for the 627, it's actually looking back to the spring semester of their freshman year and then multiplying it by this retention rate that you can see here. And which is a really nice little feature. So, if I open up our junior class here, we can see it's doing the exact same thing. So if I adjust, my freshman class from 720 to, let's call it a big number so that we can actually track these students to 900, and we select save, we now can see the bump in enrollment. So this 900 then flows down to my spring semester, and we now can see this 866 that's being, so that 900 students that we put in there is now being applied against this retention rate right here. So flipping back to the fall semester, we can even see it flowing down into the sophomore, junior, and then if I expand senior year, and finally my senior year where they graduate and enrollment levels return back to normal. This is a very important thing to track, typically, or particularly for schools where they have blip years, where their application to enrollment, the matriculation rate tends to be much higher than anticipated, which can cause significant issues with academic space, dining space, and housing space. How can we manage that? And so this will at least help, this particular set of modeling can at least help you identify, how long of a problem and how large of a problem this will be year to year. So, I made mention earlier to having two types of different retention rates. And the reason for that being is for transfers. Transfers tend to retain significantly better than your traditional four-year student. The reason for that being is primarily because they've identified a school that they did not want to be at, or they were trying to get into your particular school first, but needed to go to a lower level college to kind of get their grades up and come to this school. So they have a much better chance of retaining year to year. So as you can see here, the retention rates tend to be much higher in terms of predictability. So moving forward into, how does this then project what your total tuition is? Typically, we have an assumption account sitting in the background for your tuition rate, and basically we'll take your total enrollment, have the tuition rate, and apply that against the enrollment. And we could even include factors such as deferred tuition revenue for your summer, or depending on when your fiscal year is. So, some schools, such as the University of South Alabama, for example, their fiscal year is October 1 to September 30. So their fall semester, they have a good amount of deferred revenue from semesters from year to year. We can factor those things in as well into your enrollment planning. So undergraduate enrollment planning is pretty straightforward, nothing too complex. We do like to have history loaded in, to reference as well as to report on, but can be as complex or as simple as your college will need it to be. Now, when you flip over to graduate enrollment, this is where something can get a little bit more complicated, because you're trying to not only you're not normally tracking your graduate students semester to semester, but as well as you have your graduate students paying a per credit rate. Many of your graduate programs are not full-time. Your full-time programs are relatively easy to model out. They'll be very similar to your undergraduate program, which is full-time. And actually, something I forgot to mention on the undergraduate model is we can also model full-time versus part-time students, as well as residential versus commuter students, if you need them to retain differently as well. But with graduate students, you see a wide array of students in terms of their part-time ability, particularly for programs like an MBA, where your average credits will be about 6 credits per student. So with this particular model, we have all your different schools. So you might have a business school, an arts and sciences school, and health and nursing, and these are all master's programs. So let's flip over to your 1-year MBA program, for example, where, similar to your undergraduate enrollment program, you'll come in and identify what is your incoming cohort, and then we would also identify what, if it's a if they need to retain from semester to semester, we can have a retention rate here as well. And then you flip into a 2-year program where we can have you enter in an incoming cohort of 50, but then you have continuing students. But if you have an incoming cohort in your fall semester, we can have a continuing cohort looking back at the spring semester, so that you're tracking not only fall to spring, but spring to fall as well. And typically what we'll end up doing is with a lot of these graduate enrollment programs is we'll come up with an assumption by program for what is your average credit taken in this particular program to then drive tuition. So if I were to come into here and flip to my tuition assumptions, for example, we can see all our different assumptions for tuition modeling. So for the undergraduate school, they have a flat rate of $46,000, and then it grows by 3% in all of its out years, as well as their credit rate. If they're if you're a part-time student, we can apply an average credit taken by student, and then apply increases to those tuition rates, and we would have your total tuition dollars right here, so that as you're making changes to any assumptions, you can see that data update automatically. So for example, if I were to say we were only going to have a 0% increase in 2018 to make tuition more affordable if the college is getting priced out of its market, and it can afford a 0% increase in tuition by limiting expense growth, we can do that. And so you can see the flat rate and the per credit rate stays the same year to year, and your revenue, which normally was increasing by a pretty significant amount, is now kind of flatlining, or somewhat flatlining in the from fiscal year 17 to 18. Now on to the grad programs, where you have flat rates for your 1-year MBA versus your 2-year MBA, where we'd have your credit rate and your average credits taken. And in this particular circumstance, we had assumed 9 credits were taken per student, and this can easily be updated to show fall, or to show tuition. So for example, we see that your tuition here will be $4.6 million. If we were to flip this to 6 credits as the average credit taken, it will then run through the model for this particular program, and you'll see the tuition drop from $5 million down to $3 million, which is exactly what I would have expected. So that pretty much concludes our enrollment modeling from a very high level of what adaptive can do. The next piece, as well, as every budget manager understands, is it's not how much tuition, gross tuition you're bringing in, but what is the discount rate that's also associated with this. And financial aid has become, a rather hot topic these days of, how can we plan for, different scenarios. And one of the ways that I've seen a lot of our clients plan is breaking up financial aid into a number of different pieces. And the first piece is to identify scholarships. You know how many scholarships you're going to have. So this list that we have right here are different types of scholarships, whether they're percent-based or dollar-based. So for example, the presidential scholarship is a 100% of tuition scholarship versus a women's leadership scholarship is only 75%. Same thing with, you might have a diversity full or a diversity half scholarship, or you may even have a global scholarship where it's just a pure dollar amount. If you're from a certain part of the world, those particular students get a $10,000 scholarship. You can then bring that in over to into this sheet. So I'm just going to actually change this view really quickly so it's not as intense. Let's reload this real quickly. And we'll take a look at we'll have class here. And we'll take a look at the presidential scholarship, for example. So what you're going to want to do is, for each class, you will want to identify how many students will you have in that, that you're going to be offering those scholarships to in that individual year. And then it will automatically calculate out based upon what you've entered in on this sheet, how many students multiplied by tuition, multiplied by, either that percentage or dollar amount will get you to this rate. So if we were to flip to global scholarships, for example, we know that we're going to have 35,000 or 35 kids, and we just saw the global scholarship is $10,000 per scholarship, which then nets us $350,000 of aid. So we can add in as many programs as your school, deems, and we can make it either percentage or dollar based, as well as we can even get more sophisticated to actually add retention rates for these particular students, where we can now predict how are these students going to matriculate, as years go on. And the matriculation rates primarily due to, most students stay with programs that offer large financial aid programs, but you may have a high attrition rate for programs that require high needs of academic performance, for example. So we can then have matriculation rates on these particular students for year to year. We can then get into scholarship or need-based aid. And need-based aid is a very important factor and a little bit more difficult to model out, where you kind of determine the discount rate for your incoming class, and then you're determining how those need-based students are going to matriculate year to year. Now, these need-based models tend to work the best if the discount rate remains, or the dollar amount that the students are awarded remains flat year to year. So for example, if a student was awarded $20,000 of need-based aid their freshman year, and they meet all their academic requirements, and they retain from their freshman year to sophomore year, they will then receive $20,000 again in their sophomore, junior, and senior year until they graduate. So we would want to track those retention rates year to year. Now, where you can get a little bit more complex with this, and I know a number of my clients are doing this, is where the school matches 100% of need year to year. So that adds a layer of complexity where we would actually want to load in history of your need-based aid and how it fluctuates. And I normally recommend for finding a lot of models, I recommend 3 years, but for need-based models, I like almost 5 years worth of data to really dig into some of the factors that may cause fluctuations in need-based, where we and we can track whether a particular class was particularly economically advantaged or economically disadvantaged, to help you factor in increases from year to year. And then we can also, and then finally, within this particular model, we can also get your state and government aid amounts in here as well, such as Pell or SEOG. And then you have programs like your graduate school, where we can model that out independently from the undergraduate school, where if we flip back to this financial aid page, where we a lot of these programs are just pure dollar amounts, that are just awarded to the school as a total, and that typically happens with your graduate school programs, where your MBA or your English program is awarded $500,000 of financial aid, and it's up to the admissions director of the graduate school to go, fill the class with that aid amount. So flipping back over to this particular sheet, where I'm just going to have, we're going to take a look at the English program. Where we can see, while tuition was, 1.21, your financial aid is coming in at $500,000. And we could, if we wanted to, we could even add a discount rate directly into this model for you, which is rather easy to do. As well as if you ever wanted to override this information, if you said, all right, yeah, we may have been planning at $500,000, but now we know that this is actually coming in at $600,000. And we select save, we can actually have an override account, which will then flow through the model. And then this all comes to a summary sheet of how much financial aid dollars are awarded to the undergraduate school versus undergraduate school, and we can have discount rates shown by school so that you can manage. So for example, if your board mandated that you were to not exceed 40% of your total discount rate for the undergraduate school, well, then you can come back into your financial aid page where we're managing the undergraduate school for need-based, and we can say, all right, well, instead of offering 33%, we're now going to offer 32% across the board in perpetuity. And we'll select save here. And now this information then flows through to our summary, and we can now try to determine, are we now below that 40% factor? And for fiscal year 16, well, we didn't quite reach it, but all our out years we did. So you can then say, all right, what do we need to do for fiscal year 16 to get us back down below that 40% threshold? So all good things to kind of keep track of. And, and what are some other ways that we can kind of view this data instead of just looking at raw numbers? Well, we have a number of different reporting features within Adaptive. So I'll just show you a quick example of some reporting features, such as an enrollment and aid summary, where you can track your enrollment by your different classes to determine what your total enrollment is and how that's growing, versus your different business schools. How is enrollment coming in to here? And you could even do version comparisons of actual versus your budget. How are you trending towards your budget information? And then finally, we can even get into discovery. So Adaptive has discovery options where you can create dashboards for your different managers, such as enrollment, for example. So you can see here for graduate enrollment, we're tracking the 3 different schools. So you have your business school, your arts and science, and health and nursing. So you can track it either in a bar chart or a line graph to kind of see. So we can see here, arts and sciences is remaining relatively flat year over year, while health and nursing seeing some slight growth, but your business school is really taking off. So you can kind of identify your cash cows and identify, do we want programs to continue? Do we want to, potentially, do we need to pivot somewhere in particular programs for where we want growth, or are we growing too fast and we need to, invest more money in capital and faculty to get this program, to meet the needs of this particular program? Same thing with the undergraduate school. Where I entered in that that class of 900, where now you can see this little blip on the radar in all your classes. So you can see your freshman, sophomore, junior, and senior classes in all these years, how they're matriculating along. Now, if I were to come back into my undergraduate enrollment model and flip this back down to, 720, for example, and select Save, and I now select the refresh button for my reports, well, now this all levels out to a much more, reasonable level. Where you can see, your freshman class is exactly as you projected it. Your junior and senior classes, where historically were lower due to lower enrollment classes, are now catching up as your larger classes matriculate from year to year. And building these reports within Adaptive is very, very easy as well. And you can even, and lastly, I'll just show you some dashboards on financial aid, where you can show, where are my financial aid dollars going to by class, for example, for scholarships versus need-based aid. Do they kind of mirror each other, as well as identifying where is my financial aid going by school. You can see here that 38% is going to my graduate school, while 62% is going to the graduate school, as well as how do your discount rates change by year. So all really good metrics to kind of keep track of when planning financial aid and managing enrollment. So at this point in time, I want to just in the essence of time. For this particular, demo, I wanted to open the floor to questions of, is there anything that we can, that you want to see within this model, or, questions about, can this flow to, room and board and things of that nature? I want to open up the floor.
Excellent. And actually, John, we do have a couple questions that have come in. And for those of you who do have questions and haven't asked one yet, just a quick reminder, there is a Q&A section at the bottom. But to your point, John, there have been a few individuals that have sent some messages with some questions. The first one being, can the enrollment model automatically drive the room and board, financial aid, and study abroad models?
Absolutely. So a number of our clients' models, we use enrollment as our base for which is a major driver. And, for room and board, we link enrollment directly to those particular models. And, particularly it helps, directly with financial aid. So we actually see in one of these models, I believe it was the graduate. Yep, so the graduate, we linked tuition. So that tuition number you saw in the graduate enrollment, we linked directly to this financial aid model, and we could also link enrollment directly to there. It's particularly enrollment for room and board, where we kind of identify, all right, where's our base enrollment? How many students are living on campus? How many are commuters? Are those commuters eating meals on campus? And then, we could even have, rates for your traditional enrollment students versus your transfer students as well. So all things that can be factored into any of your, models as needed. Any other questions?
Yes, another one just came in. What is the implementation time for a model like this?
So for a model like this, if we're not, if you don't need to have, program fund class, implemented into your model, you're primarily just doing, planning by general ledger account and department. We typically see anywhere from 175 to 225 in terms of the hours to implement. But if you are getting into the more complex models where you need to see, significant endowment planning, debt planning, capital, room, board, study abroad, multiple versions of enrollment, as well as endowment planning, faculty versus staff, they can get up to upwards of 500. That's the largest that I've seen. But those models they're very large and quite robust. And we've been able to meet almost all of our clients' needs so far in the higher education space.
Excellent. We did have another one come in. Is Discovery part of the base package with AI, or is it still an add-on?
Mr. Mooney, I think you might be able to actually answer that better than me. I still believe it is an add-on.
That's correct. Yes. And if it is of interest, certainly happy to address that, here offline, and I will send a note along with what that would entail. So you are correct, John. But yes, I will send information here shortly to address that question a little bit further.
Great.
Also, another one. Yes, can adaptive use historical trends to predict retention and attrition rates?
Yes. Yep. So we had reviewed that on the enrollment page. Many of my clients, do use, historical retention rates where we'd actually have the you'd enter in your enrollment amount in each class, and we'd have retention automatically calculating in your actual version. So one of the things I didn't review today in this particular call is, Adaptive has version control where you can do what if type scenarios, and we have an actuals version where you can host all of your historical data. So within that, as you can see here, we have our forecasted data with our actuals data right here, and we can have it, reference points of time to predict retention moving forward based upon historical rates.
Excellent. And I did have one more come in. Can we have one assumption page where we enter the enrollment discount rates, other revenue assumptions, and expense growth assumptions?
Yes, you can. So I typically do like to have one page where, you just enter in all your assumptions. And, we had identified, some tuition assumptions, for example. We can have an all assumptions page where you would enter in, your salary growth rates, your income, we could have it linked so that your incoming freshman cohort is directly on there, inclusive of your transfers. And you could have, your endowment return on investment rates, your drawdown rates. You can, expense growth rates for different expense categories, such as if you wanted utilities, utilities group growth rate, supplies growth rate, training and administrative, travel and entertainment, all very easy to do. So that, you just have kind of a one-stop shop page where you can enter in all your model assumptions, and then it would drive all these supporting schedules, which would then flow to your income statement. Great question.
Excellent. And we do have a couple more that came in, but we'll have one last one before we wrap things up. And the last one we'll address, and I'll get to the other questions here after the webinar. But can adaptive plan for both faculty and staff personnel with different salary growth rates by employee type?
Yes. So I have a number of different clients who, for one reason or another, the staff administration doesn't have access to faculty salaries, and faculty administration don't have access to staff salaries. So we need to build out two different personnel rosters. Or you could have staff and faculty on one personnel roster, where we, just like kind of identify the employee type, as you had mentioned in your question, where we would say, if the employee type is staff, then use this assumption rate. And on the assumptions page that we were just referencing, we would have two different assumption accounts, one for a staff salary increase and one for a faculty salary increase. And I have seen a number of different institutions have two different rate increases for their faculty versus their staff. So very good question.
Agreed, absolutely. And with that, we are approaching the 2:45 time, and want to take this opportunity to thank everyone for joining us today. And John, thank you very much for the demonstration specific to higher education. We welcome any and all questions. If anyone has any follow-up that they would like to do after this webinar, please feel free to reach out. Always happy to chat about your current situation, maybe some of the pain points that you might be experiencing, and always happy to address those questions. And we will also be certain to follow up with the additional questions that have come in, and I will also be certain to send along the recording of this webinar, as I mentioned at the beginning of the hour. So with that all being said, thank you, everybody. Have a wonderful day, and we appreciate your attendance here today. Thanks so much.